Google's cheap, AMD is exploding, and Nick says that the real risk is not buying. We break down the setups, the strategy, and what's driving these trades right now. All right, Nick. I love getting you back every week or two to just talk markets. Listen, while I analyze the markets on this channel with all sorts of technical analysis, options are near and dear to my heart. And there's no other guy that I love to talk options more with than you. And listen, crazy market. Market's been ripping, and some of these Mag 7s and other stocks have been turning up. And we were having a conversation, and you were talking about that you're messing around with Google and AMD, and I just wanted to pick your brain on this, and we could talk some option strategies and the technicals and so on. So let's start off. Let's start off with Google. I'm going to just pull up the chart here. What are your thoughts here? Obviously, they had a dip. I'll let you explain now what happened last week that caused the stock to have a little bit of a dip, but it's nicely recovering that, still below the 50-day, but you got a bullish thesis. What's your thoughts?
Yeah, so right now, pretty simple. Google's a very, very cheap company that's generating a lot of cash flow, and they have a lot of cash on hand. And I love their business overall. I think the rumors of their death are very premature. There's been discussion on how search is declining, and that comprises 54% of their revenue roughly right now. But they are a leader in AI, in quantum computing, and in search. And they have so many moonshot projects in addition to that. Like, you could split up their business and each one individually be worth a lot as well on its own. So right now, I view it as being very, very cheap. And typically when you see this happen, like, this reminds me a lot of what happened to Meta back in, I think it was 2022, I believe, when Meta fell down to like $90 or so on that huge investment into the metaverse. And everyone thought, okay, they're going to die as a company. They're going to bleed too much cash. Look where they are now. They're $600 a share. They've exploded. I think Google is going to have that same renaissance after everyone understands how serious of a player they are in AI and quantum. And right now, they're generating over $1 billion in revenue each day, which is absolutely insane. And they're very cheap as a company. So very, very simple thesis. I think it's actually riskier not to buy them than it is to buy them here on this decline. Right?
Wow. All right. Look at that bold call there. All right. So listen, here's the technicals. You obviously had a drop on the downside here, where basically I call it like a key bottom retest, and it's been recovering. For me, technically, I would love to see Google be able to get back above the 50-day and really solidify that this is a bottom. I mean, the whole market is ripping and Google's been left behind. It'd be interesting to see whether it can actually join the party. The interesting part from a Fibonacci retracement perspective, you're talking 175 to 180 is a very typical retracement. So even if this isn't a new bull market, it's reasonable for it to retrace some of these losses to get up in those levels. So let's talk option strategies and what you're looking at. So you specifically wanted to go out on Google out to June. So why don't we talk about what your idea is and how you're structuring your trade?
Yeah, so I mean, I'm already in a trade right now that has already kind of come to fruition and generated a lot of profit. Back when it was around 150 a share, I got the 155, 160 call spreads for this Friday, and they're already at maximum profit basically. I also got the 160, 170 call spreads for June OPEX, which are now pretty profitable. But given that we're trying to discuss actionable insights to our listeners, what I recommend here is looking at the 170, 180 call spreads purely on an asymmetry risk standpoint. They cost about right now like 160 or so risk to make a maximum profit of 840. So the asymmetry risk is incredible, and a recovery should happen pretty quickly. We typically see the bounces happen pretty fast on Google. And again, if the timing is off, you don't lose very much. It's 160. For example, let's say, I'm not saying you use a stop loss, perhaps you size down a bit, but if you stopped out, let's say 80 cents, that's what you could do if you're sizing heavier, or you just let it run to maximum loss if it expires worthless. And then what you do is you roll forward to July then, right? Or to August then. Because ultimately, I think it's going back into that pocket of like the one, you mentioned 175, 185 area. I think that's where it's going to end up very, very soon. Like, we're talking before August. Will it happen before June? Perhaps not. Will it happen before July? Who knows? I do think right now that it's a great asymmetry of risks play, and that's how I approach all my trades, asymmetry
So,
of risk, right?
so here on the chart, I drew the red line for the June 20th expiration, and the red box represents your spread kill zone, right? Like this is where you want that price to slam into on the upside. I think that there's a very reasonable chance on that to be able to get something that is going to pay off 4-1. Is solid. Like so here, what I'll do, I love this feature on is where we can put your break even on this thing, which was what did you say, it was a $1.60 to open this thing?
Yeah, it's like 160, 160, or sorry,
Yeah. So
170, 160 roughly. Yeah.
yeah, so what you can see is like that red zone right there is your risk, and your versus your payoff there. And so anyway, the point being here is that you got a really nice payoff structure to this trade, and ultimately, if it's not working, you can always cut out early and recover some of the capital. But it is such a small capital outlay. The very advantage, and listen for our listeners, why do a debit spread? Let's just take a moment and dive into this very question. So to do a debit spread is where you reset your risk reward to a very definable amount. You say, I only want a sliver of participation. I want the participation between $170 and $180, right? I'm just going to participate in that, and on a probability adjusted basis. The option value is what determines what is that price, and so that price was $1.60 to buy a potential $10 intrinsic value, or $8.40 profit. Totally worth the risk. You know, if the whole trade blows up and Google goes down to 140, 130, someone who bought the shares could find themselves down 20, $30 on the spread. You only lose the $1.60 at most. And so it allows you to take a legitimate shot to make money on the upside of Google without exposing yourself to a lot of that risk of owning it. Now, listen, we have a few more minutes because you had another idea I wanted to share. So this one, you were talking about a trade you were doing on AMD.
Yeah.
So what are your thoughts here? Obviously, AMD has been in a brutal bear market, been murdered over the last year. Now we got a V-shaped recovery, which is basically the entire April loss has been erased on the upside. It's back above its 50-day moving average, something we haven't seen really since September of last year. So you think there's a new bull trend? What are you thinking here?
I do. I mean, their earning report last week was phenomenal. They crushed on every metric. Their guidance was solid. And I think that they are going to be competing with NVIDIA very, very shortly. I think that their valuation, again, my opinion, could easily double or triple in the next 5-6 years. And as a result, I think the stock could trade at, $500 5 years out, right? It sounds outlandish right now, but back when AMD was $20 a share, no one thought it'd be $100 within a few years. I think they could easily 5x from here. That's my ultra bull thesis. My conservative thesis is more so 150 to 200 pocket, which I think could happen in the next year easily. And I actually have leaps on AMD for 2027 January, which I bought near the bottom. Obviously now they're much more expensive, but the idea here is that if you want to participate in upside, as Patrick mentioned, without having that huge downside risk in the event that you're incorrect in your thesis, call spreads are a great way to do that because you're defining your risk and your reward. And basically you're outlaying a small amount of capital, which if you're incorrect, it doesn't hurt you at all. That's kind of the beauty of the strategy of using asymmetry of risk as your pinpoint or your compass on how you decide to make trades.
All right. So what's the trade, buddy? Which strike prices are we choosing?
We're choosing the 120 to 140 call spreads for the July OPEX. So we have 2 months out, and the current debit's about $3.70 roughly.
Right.
To make a maximum profit. Sorry.
Go ahead.
To make a maximum profit of 16.30, I think it is.
Yeah. So again, you've got a very similar 4-1 payoff ratio on the upside. You have all the way till the July expiration for this to materialize. And so if this becomes a summer rally on the upside and this stock continues to recover, this thing could start building some good intrinsic value on the upside. I think, well, great ideas, Nick. I think what the theme over here, I think we can just summarize is, okay, you're looking for these things to continue to participate on the upside in this recovery window in the markets. Now, The key is that you said that we want to put these on with debit spreads. Now, for those listeners that don't use options, everyone hears that options are risky, but I would have viewed them actually as an amazing risk management tool, because in the end, stocks have a very undefined risk. Think of how volatile some of these stocks were in the month of March and April, and the types of swings that they had. When we use options, we allow to know what our worst case scenarios are, and that there's some sort of a legitimate payoff profile built into the trade. That kind of structure is not made available to stock only investors, and this is why I love options, and so do you. So Nick, where can they find you if they want to know more about you, buddy?
My website, optionfinity.com. That's OPTIONFINITY.com. It'll be linked below, I guess, as well. And yeah, you can hit me up on there. There's a sheet to fill out if you want to contact me and ask a question about your own strategy. I reply to all the emails. So yeah.
Thanks, Nick. All right, next week or the next couple of weeks, I'll come up with some great trade ideas that we'll discuss in the coming weeks. Thanks, everyone, for joining us. Till next time. Cheers.
Thanks, guys. Take care.